Opendoor had a tough session on Wednesday, closing down around 25% after releasing its Q2 earnings the night before. For those of us who have followed this stock closely, this wasn't entirely surprising. But even within that sharp drop lies a deeper narrative that's worth exploring as we wrap up the trading day and look toward the rest of the week. First off, let's be clear, the Q2 results themselves were actually quite decent. Opendoor sold 4,299 homes, generated $1.6 billion in revenue, up 5% from the previous quarter, and achieved an 8.2% gross margin with a $128 million gross profit. Contribution profit came in at $69 million, and most notably, Opendoor posted a positive adjusted EBITDA of $23 million. That marks the company's first profitable adjusted EBITDA quarter in 3 years. Net loss narrowed to $29 million, and adjusted net loss came in at just $9 million. On paper, that's real progress. So why the dramatic sell-off? There are a few factors at play. Firstly, the company gave a softer outlook for the second half of the year. That's something the media latched onto almost immediately. Headlines from outlets like MSN, TipRanks, and Investing.com have zeroed in on reduced acquisition volumes and lower inventory levels. But it's important to contextualize that outlook. Part of the reduced forecast is a reflection of macroeconomic conditions. With interest rates still sitting high, Opendoor is being more conservative in its home purchases. This isn't a sign of weakness, it's a sign of discipline. You don't want a company in this space overextending itself in a fragile housing environment. And there's another angle to this: seasonality. Q4 is traditionally the slowest quarter in the real estate calendar. Between colder weather, holidays, and general year-end inertia, fewer people are buying and selling homes. So when Opendoor tells us they expect reduced revenue in the back half of the year, they're not warning of systemic issues, they're being transparent about the realities of their industry. And frankly, that's what you want from leadership. Now let's talk about the aftermarket reaction. The 24% sell-off in after-hours trading on Tuesday night definitely set the tone for Wednesday's market action. But I think it's important to keep perspective here. After-hours markets are typically low-volume, thinly traded, and prone to outsized moves. What we saw Tuesday night was less of a rational repricing and more of a knee-jerk reaction from traders trying to front-run Wednesday's open. That said, Wednesday's follow-through confirms that sentiment has been temporarily shaken. But here's the thing: I don't think the underlying bull case has been invalidated. In fact, I used this dip as a buying opportunity. I added to my position because I believe there are still strong tailwinds forming around Opendoor. For one, let's talk about interest rates. Earlier this week we got some soft job data, a signal that the labor market might finally be cooling. If that trend continues, it raises the probability of a Fed rate cut as early as September. That would be a game changer for companies like Opendoor. Lower rates would mean cheaper financing, more inventory turnover, and potentially higher homebuyer demand. And if the Fed does pivot, we could see Opendoor's guidance for Q3 and Q4 suddenly look too conservative. That's how quickly sentiment can shift, especially in a sector as rate-sensitive as real estate. From a trading perspective, short interest in Opendoor remains elevated. The recent rally in July saw a number of shorts get squeezed, but not all of them. Many are still holding underwater positions. If Opendoor stabilizes and starts to climb again, we could see another round of short covering that drives the stock higher, fast. We also can't ignore the retail angle. Opendoor is once again showing up in trending stock trackers, Reddit posts, and retail trader watch lists. But what's different this time is that there's more substance behind the interest. It's not just about chasing momentum. People are digging into the earnings report, analyzing gross margin trends, and weighing the implications of a potential rate cut. Now, there has been some chatter from EMJ Capital and executives connected with Beyond Incorporated, who've offered more optimistic takes on Opendoor. While not official endorsements, the tone from these corners of the market adds to the growing narrative that Opendoor may be undervalued at current levels, especially when you consider its path to profitability and the recent regaining of Nasdaq compliance. Let's also not forget that just a few weeks ago, the company was preparing for a potential reverse stock split to avoid delisting. But now, with the stock consistently above $1 and official compliance regained, that's no longer on the table. That's a win. It removes a layer of uncertainty and restores some investor confidence. So where does that leave us heading into the rest of the week? We've got a stock that's been beaten down short-term but has positive earnings momentum, clear macro catalysts, and renewed interest from the retail crowd. It's not hard to imagine a scenario where sentiment rebounds, especially if broader market conditions remain favorable. Yes, risks remain. The housing market is still tricky. Opendoor's margins are slim, and any missteps could derail this recovery story. But from where I'm standing, the fundamentals are improving. Leadership is staying disciplined. And the market may be underestimating how quickly things can shift when macro winds start to change. For those of you watching from the sidelines, keep an eye on volume over the next few sessions. If we see strong buying activity, particularly from retail, that could mark a turning point. And for those already holding, like myself, the dip, while painful, might just be part of a bigger setup. Thanks for tuning in. If you found value in this breakdown, please consider liking the video and subscribing to the channel. Drop a comment below. Did you buy the dip, hold through the storm, or sit this one out? Let's keep the conversation going. See you in the next one.